Okay, so I'm going to start with fixed income now, right? You all can see the screen?
Yes, sir.
Okay, so fixed income securities. So first of all, what do you mean by fixed income securities? What do you mean by security? So security means it's a general term, okay, for any financial instrument. It's a general term for any financial instrument. That means what? Equity is a security, bond is a security, okay. Uh, Mutual fund is a security, derivative is a security. Any financial instrument which has monetary value, we call that as what? Securities. It's a general term, okay. So out of all these securities, we are going to focus on fixed income securities. So what is that fixed income? Bond is an example of fixed income security. That means a financial instrument which is going to give you fixed income. A financial instrument which is going to give you fixed income. That is called fixed income security. So this fixed income securities, examples or fixed income securities, under this we can, it can be categorized into long term fixed income securities and short term fixed income securities. Okay, long term, for long term example is bond, and for short term money market instruments. Money market instruments. Okay, now let's begin the story from this bond. Okay, now what is bond? So normally, even if you are not coming from finance background, then you would still know that bond refers to an agreement. Bond refers to an agreement, correct? Think from non-finance perspective itself. So bond refers to an agreement. Now agreement as in what? Agreement is between two parties. So over here, it is an agreement between borrower and the lender. So bond is an agreement between borrower and lender. Okay, you must have seen people saying like this, you have to sign the bond if you are borrowing. Okay, that means an agreement. Okay, borrower and lender. Now, who is this borrower? Borrowers are companies or government. Why would a company borrow money? Because they want to expand their business. So they are borrowing. Why would the government borrow money? Even though they are getting revenue in the form of tax, but then that is not sufficient. So they also tend to borrow. Okay. And who is the lender? So lender can be people like you and me, retail investors. We are giving money. So we can invest in government bonds or corporate bonds also. So retail investors. Then HNI, high net worth individuals. Okay, high net worth individuals. Then that means rich people. Okay. Then institutional investors. Institutional investors. Who are these institutions? Like bank. Okay, then insurance companies. Okay, then mutual funds, pension funds, hedge funds. They all are the lenders here. Now, when agreement happens, agreement on what? So, agreement on the principal amount that is being borrowed. Principal amount that is being borrowed. So, um, let's say that is 1,000 rupees. That is 1,000. And then what is the agreement about? Agreement is about the interest rate that will be paid. So interest rate. So let's say interest rate is 10%. Agreement on the frequency of interest payment. Frequency of interest payment. So frequency of interest payment, whether it is per annum or semi-annual or quarterly or monthly. So imagine here it is per annum. Okay. Then agreement on the maturity. When will it be repaid? Maturity. So let's say this is for uh, 4 years. So it will be repaid in 4 years. Fine. These are some of the uh, conditions. Okay, some of the conditions in the agreement. So basically, then what is bond? Bond uh, is an instrument through which a company borrows on long-term basis. Okay, because the maturity period will be more than 1 year. So a company or government borrows capital on long-term basis for borrows capital on long-term basis. Okay, fine. Okay, and these are all the conditions. It are the characteristics of bonds. It consists of principal, interest rate, frequency of interest payment, and maturity. And plus, there can be many other clauses also, but these are all something which will be majorly there. Okay. Now coming to uh, the relationship between interest rates and bond price. Interest rate and bond price, very important one. So relationship between interest rate and bond price. See, like imagine you have bought Muthoot Finance bond. Okay, and they have promised you 10 percentage. So every year they are paying you 10 percentage as per the promise. So it will be mentioned in the prospectus. Okay, now instead of saying prospectus for bond, it is called as indenture, or it is also pronounced as indenture or indenture. Okay, 10 percentage. Now this is 1, 2, year 3, 4, 5. Now suddenly here in the market, imagine the interest rate goes up because of whatever reasons, because of some geopolitical reason, because of which oil price goes up and some war happens and the interest rate has gone up from 10 to imagine 15 percentage. So and at this time L&T is another company. Now because in the market it is 15 percentage, L&T is issuing bond at 15 percentage. If L&T is issuing bond at 15 percentage, your friend wants to buy a bond. Okay, now at that time, say for whatever reasons you want to sell your bond, maybe you are going to another country or you are in need of money, for whatever reasons you want to sell. Now whoever buys your bond, they will get how much? 10 percentage. Whoever buys your bond, they will get 10 percentage. Whereas if your friend buys L&T bonds, your friend will get 15 percentage. So obviously their preference will be L&T bonds, but somehow you want to sell your bond and get rid of this bond. So what will you do then? So what will you do? Like what happens normally when you go for shopping and all, and if the shopkeeper thinks that old stock and he wants to get rid of somehow, so what will you do then?
Sell at a discount.
Yeah, so you will reduce the price. That means when the interest rate in the market went up, the price of the existing bond came down. Bond price is coming down. Is this okay? Okay.
Yes.
Now vice versa. Instead of interest rates going up, just imagine interest rate, came down again for some reason. It came down to 5%. Now L&T is issuing bond at 5%. Now your friend wants to buy. So will your friend buy from you or your friend will buy from L&T? Your friend will buy from you, right? Because if he buys your bond, this your bond, Muthoot Finance will give 10%, whereas L&T is giving what? 5%. Okay. So now you know that people are demanding your bond. So initially, when there was no demand, you reduce the price. Now there is demand. Then what will you do? What will you do now?
Sell it at a premium.
Yeah. So that means when the interest rate in the market goes down, bond price goes up. This is called inverse relationship between interest rate and bond price. Inverse relationship between interest rates and bond price. Okay, inverse relationship between interest rate and bond price. Okay, so that's why whenever RBI speaks about interest rates, when they increase or decrease, the next day, if you see the newspaper, when the central bank increases or decreases the interest rates, you will see next day business newspaper will speak about bonds. Okay, fine. This is a very important concept. Okay, now next one, types of bonds. So what are the types of bonds? So number one, what normally it should be like, if it is a 5-year bond, so it's a regular normal bond, is regular bond, 5-year bond, 1 2 3 4 5, and imagine 10% principal amount, which is also called face value, is 1,000, and coupon is 10%. So coupon means what? Coupon means interest. Now why is it called as coupon? Because in those days, before electronic age, certificate used to be given for owning bond. You will get certificate, your name will be printed on the certificate, and behind the certificate there will be coupon attached. Okay, and you have to, just like when you go to your hotel and when you pay money to the cash counter, you will get coupon, and you will take that coupon and you will go to the food counter and you will exchange it for meals. So coupon is used to exchange, right? Similarly here also, you will get this coupon, and on the day of interest payment date, you will tear this coupon, you will go to the company and you will exchange it for interest. So it came to be called as coupon. Okay, the terminology became very popular, coupon, right? Okay. Yeah, so that's why we say, we still use this word coupon. Okay, so coupon means basically the interest that the company is paying on the bond. Okay, so 10% of this 1,000 is what? 100, 100, 100, 100 and 100, and then at the end you will get 1,000. So this is normal cash flows for your bond. Now this is normal regular bond. Another one is zero coupon bond. Now zero coupon bond means what? Zero coupon, that means no coupon. So now company says, give me 1,000. Okay, here also you invested 1,000 and the company kept on paying 100, 100, 100, 100, 100 and repaid your principal amount. Here when you give 100, company will not pay anything. 0 1 2 3 4 5. Okay, but at the end, so if there is, if you are not going to get anything, then why will you invest first of all? So it's not that you will not get anything. At the end, company, will pay you huge lump sum amount. Say for example, 1,600 they are paying you. So zero coupon means no periodic payment happens, but at the end you will get a huge amount. This amount will be considered as the face value, because even though you are paying only 1,000, you can claim 1,600 from the company. So that's why the actual value for this bond is 1,600, which you got it by paying 1,000. Okay, so I can say zero coupon bonds are issued at discount. Zero coupon bonds are issued at discount from the face value. Issued at discount from the face value. Okay. Now, why would your company do like this? Say, for example, L&T company, which is making a metro rail. Now they are issuing bond to make a metro rail. Now it will easily take like 5 years to make one metro. So now company says, look, you give me money, I will use this money to build metro. But how can I give you interest immediately after 1 year? Because this metro itself will take 5 years for me to build. Then passengers will travel. Then I will collect tickets, and then only I will be able to pay. So I need some time, 4 5 years I require. So that's why that L&T cannot afford to pay you every year. So if that is the case, they may go for what? Zero coupon bonds. Is it okay? Have you understood this one? Zero coupon bonds.
Yes.
Clear? Okay. Then next one, callable bonds. So callable bond means what now? Callable means these are all some additional clauses that the company can put up. But whatever they put the additional clause, it has to be mentioned in the indenture at the time of issuance itself. So callable bond means the company is paying 10 percentage every year. That means 100 rupees. Now here company knew that quite possible that the interest rate might come down highly. So the interest rate is 5 percentage. Now when the interest rate is 5 percentage, L&T is doing business by raising capital at what rate? 5 percentage. Now here L&T is raising capital at 5 percentage. As an investor, you are very happy that you invested in Muthoot Finance and you are getting 10 percentage. Okay, now you think from Muthoot perspective, will they be happy to give you 10 percentage when L&T is giving only 5 percentage? Muthoot is not
No.
going to be happy, right? Yeah. So then what will Muthoot do? So now they have the right to call back. Think from derivatives perspective. What is call option? Call option is uh, right to buy, correct? Right to buy. Okay, right to buy.
The holders would have the obligation to sell,
So
right?
yes, the investors will have the uh, uh, no, he is the holder, right? Company is the holder. They have the right to buy, and the investors will have the obligation to sell. That time investors cannot say no. So company will say, look, I'm paying you 10 percentage, which is like too heavy for me. So company will say, like, I don't want to continue this bond anymore. All this I don't want. Okay, I'll give you one another example. Say for example, you took one home loan and you said, like, you are going to pay for the next 30 years EMI. Then suddenly after 2 years, you are going to KBC, Kaun Banega Crorepati, and then you are answering some 10 15 questions and you became a crorepati. Now what will be your next step? You would like to prepay the loan amount, right? You want to close it. You don't want to continue paying interest now. Similarly here also, you don't, company does not want to pay 5%. Company does not want to pay 10%. That is a very high amount for them. So what the company will say is that I want to finish up this relationship. I want to, pay off your money, and this lender borrower relationship, I want to close it off. Just like how you will pay once you get crores, you will pay off to the bank and you will close the loan amount. Similarly, here also, company is doing the same thing. Okay. Yeah, L&T. Okay. So now, so what will the company do? Company will call back the issued bond. Company, they will have the right to call back. So if at all they want to include this feature, it has to be mentioned at the time of issuance itself in the indenture. Okay. Fine. Yeah, and if you are the investor here, when you are reading the document, you get to know that it's a callable bond. Then you are thinking, you don't know after 5 years whether they will call back or not. Everything will be mentioned when they will call back. If at all they are calling back, it will be after 5 years. All that clearly it will be mentioned. Okay. So now you have a doubt whether it will be a 5-year bond or a 10-year bond, whether it will be called back or not at the time of buying bonds. So you might not show interest in buying bonds then. So it is impacting the company. So what the company will do is, company will say, look, investor, don't worry. If at all I buy, I will pay you little more. So little more means what? I took 1,000. I will give you like, uh, uh, 15, 20% little more. So I will give you, or 10% little more. 1,100 I will give you. So that means generally callback happens at premium. Generally callback happens at premium. Okay, is this fine? Understood? So when will, and if required, they will reissue at 5%, and they will automatically save what? In between remaining 5% they will save. It's a good deal for the company, right? Without doing any business, they are saving 5% here. Have you understood? Callable bond means, it gives the right to the company to buy back their bonds. Okay, and repay the borrowed amount back to the investors, and generally they pay more. That means they call back at premium. Okay, this is callable bond. Then what should be putable bond? Putable bond is just the opposite. So putable bond says, putable means, so callable bond, it is favoring whom? The company or the investors?
Company.
Favors the company. Now putable bond, what happens here? Put means what? Right to sell. Right to sell. So this right is given to the investors. Here right to buy is given to the company. Right to buy is what? Given to the company. Okay, this right is for the company. And here, okay, so 10, 10, 10 percentage. Okay, now imagine interest rate has gone up 15 percentage. Now when interest rate has gone up to 15 percentage, now company, Muthoot is very happy to do the business, only by paying 10% to the investors. L&T is paying 15%. L&T is paying 15%. Okay. So now Muthoot is very happy, but investors are not happy because you invested into Muthoot Finance and you are getting only 10%. So now what to do? So now, whereas your friend has invested in L&T and they are getting 15%. So in this case, you have the right to sell. So investors will get the right to sell. Will get the right to sell. Right to sell the bond back to the company and get back their principal amount. Okay, and get back their principal amount. Okay. So they can surrender it back to the company. They will get 1,000 rupees back and invest that 1,000 rupees into L&T and get 15%. So this is favoring whom? Company or the investor?
Investors.
Investor. So this favors the investor. Favors the investors. This favors the investor. Okay. Now there is no premium and all those things over here because already company is giving additional facility, the right to sell it and get back the money. Okay. This is putable bond. Then next one, convertible bond. Convertible bond means again 10% every time they are paying, and then after the specified time period you have the right to convert your bond into equity. So imagine this is, you paid 1,000 and you are getting 100 every time. Now here, let's say 1 2 3 4 5, okay, 5 6, and this is 7th year. Now here assume here this is a convertible bond and the equity price has gone to 1,200. This is equity. So now you are thinking, why not to convert your bond? You paid 1,000 only, right? Why not to convert your bond into why not to convert your bond to equity and get why not to convert your bond to equities and get extra amount? 1,200 it becomes, right? So if that is the case, you will convert. If it is trading at 900 equity, then you will not convert. So it is up to the investor to convert or not to convert. Okay, so typically when will you convert? When the equity price is more than the bond price, then you will tend to convert. So this is convertible bond. Okay. Then next one, convertible bond. Next one, floating rate bond. So what is floating rate bond? Floating rate bond as in floating, that means changing. Every time period it will change. So here company says, I will pay you interest, but it is linked to some other reference rate. So generally it is called, general term is market reference rate, MRR, market reference rate. So which are those MRR? Say for example, a very simple example if I give, it will be something like, CPI, consumer price index, inflation, plus let's say company says I will pay you 2% more. So if inflation is 5%, company will pay 7. If inflation next year inflation goes to 6, company will pay 8. If in next year inflation goes to 4, company will pay 6. If next year inflation goes to 5, company will pay 7, because it is 5 plus 2. Like this, based on inflation, it is indexed to inflation or it is linked to inflation. Okay. Other more accepted one is MRR, market reference rates, are something like SOFR. SOFR means secured overnight funding rate, or Euribor. That means here all international banks are borrowing and lending against each other. Okay, so at what rate they are borrowing and lending, that will be factored in, and then plus this extra amount will be given. This extra amount is called quoted margin. Quoted margin. Okay, extra amount is called quoted margin. So SOFR, secured overnight funding rate, then Euribor, European interbank offer rate, then this is SONIA, that is sterling overnight index average, and then in India, we have Mumbai interbank offer rate. Okay, so what I would request is read about all these things. Okay, secured overnight funding rate, Euribor, and then sterling overnight index average. So the rate, so say for example, if it is linked to SOFR, then at whatever rate here borrowing and lending is happening, on at that rate, plus it is benchmarked to that rate, plus quoted margin extra will be offered to the investors. That means every year it will keep changing now. Okay, every year it will keep changing. Okay. Yeah. Then this is floating rate bond. Then what are the other bonds? Simple foreign bonds, foreign bonds, or international bond. So foreign bonds, foreign bond means, let's say Microsoft is coming to India and issuing bonds here, so it will become foreign bond. It's a simple one. Okay, company from one country issuing bond in another country. Then euro bond, this is little different. Euro bond. Euro bond means what? Now you don't have to go with the name euro. So not necessary that Europe has to be associated with this bond. Euro bond means company from one jurisdiction. Example, India. Indian jurisdiction company, Reliance. Raising capital from another country, Japan. Okay, denominated in some other third country's currency, which is US dollar. If this is the case, okay, then it is called as euro bond. Company from one country issuing bond in the second country denominated in some third country's currency. Okay, so everything is different over here. If that is the case, then it is called as euro bond. Okay, so euro bonds are unregulated. Okay, euro bonds are unregulated. Unregulated, and it is issued in bearer form. What do you mean by bearer form? Bearer form means, say for example, currency is in bearer form, right? Like for example, see, if I take your certificate, 10th standard certificate, it is still yours only. Why? Your name is printed. So even though if I take your certificate, still it is yours, it belongs to you. But if I take 100 rupees from you, then it becomes mine, right? Because your name is not printed over there. So it is in bearer form. Currency is in bearer form. So if you give me 100 rupees, it is mine. And if I give that 100 rupees to somebody else, to a shopkeeper, and if I have food, then this 100 rupees becomes the shopkeeper's. So whoever is holding this 100 rupees, it is theirs. That is called, in bearer form. So similarly, euro bond is in issued in bearer form. So your name will not be printed there, not registered. So whoever is holding, they are the owner. That way it works. Okay. Then what are the other bonds? Deferred coupon. There are some. These are all the majorly. These are all the types of bonds. Some other like deferred coupon bonds. Deferred coupon bond means what? Defer means delaying. So company will say like, I will not pay anything for the first 3 years. Fourth years onwards, I will pay you 12% return. 4, 5, 6, 7. I will pay you 12% return. So then it is called as what? Deferred coupon. Deferred coupon bond. Okay. Then anything else? Any other type of bond? Any other type of bond? There are, a couple of bonds. Whatever major types of bonds are there that I have told you. There are a couple of other bonds, but that's okay. That when I will take you through the book, I will again see if I have missed out on anything, and then I'll explain it. Okay, fine. I think this much is enough. Different types of bonds. Fine. Okay. Any questions on whatever we have done so far? Any questions?
No, sir.
Okay, fine. Then we will stop now here.
No, sir.
Okay, so we'll stop now here. Okay, fine.
Bye, sir.
Thanks.
Thank you.
Okay, bye. Bye.
Thank you.
Yes.